On behalf of Indian Chamber of Commerce, I would like to express my pleasure in welcoming Ms. Shri Supratim Bandyopadhyay, Chairman PFRDA. It also gives me a great delight to welcome Mr. Suranjan Banerjee, Associate Director, Retirement, Willis Towers Watson, for being with us today. I also welcome Ms. Mahroz Kamdeen, Partner, Deloitte Haskins and Sells LLP, for joining us today. I also welcome Mr. A.G. Das, Executive Director, PFRDA, for joining us today. I welcome Mr. Sudhin Roy Chaudhary, retired member, Life IRDAI, member ICC National Expert Council, BFSI. Ladies and gentlemen, the Indian pension industry is a complex and fragmented system. However, the current markets for pension fund providers. Further, the country's rich demographic dividend calls for a robust social security framework. As of today, there are virus, and well, our fatality rate may be low, but whoever has gone through for the first time, this pandemic security, which unfortunately is not there in our country. I was given statistics today that 7% of our population into the main stage of people's lives. The three most crucial elements of the pension fund industry in India are Employee Provident Fund, the EPF, the Public Provident Fund, the PPF, and the National Pension Scheme, NPS, catering to the needs of the different segments of population. The retirement fund corpus was worth about 2.3 lakh crores in 2018 and is expected to reach 6.2 lakh crores by 2025, expanding at a compound annual growth rate of nearly 14.33% during the 2025 period. I'm very sure that these rates are going to go up dramatically with the experience of this pandemic that we are all going through. Unfortunately, India does not have a universal pension program for its 1.3 billion people. The increase in life expectancy, aging populations, and decline in the traditional family structure are now placing a growing financial strain on the social security safety nets, making it difficult for governments to support their senior citizens. It can serve two major objectives. One, providing income security to a vast multitude of our aging population, including in the informal, unorganized sector, and garnering long-term funds for critical growth-driving sectors of the economy and the capital market. A sound, efficient, and reliable pension system in the economy has gained urgency in view of the COVID-19 pandemic. The uncertainties emerging out of the COVID-19 pandemic saw 30% increase in individual subscribers in the National Pension Scheme, the NPS, in the first quarter of financial year 21 compared to the same period last year. Thus, the pandemic has brought in the realization that retirement planning is not a mere saving or tax benefit choice, but about securing one's financial future. The ICC, even in these trying times, through its webinars, have been actively involved in knowledge sharing regarding different sectors of economy as well as different aspects of business. Today, this webinar is organized as an attempt to disseminate knowledge about the benefits of pension planning and encourage adoption of pension products. With these few words, I welcome all our eminent guests and speakers and look forward to a fruitful.
Thank you, sir. Now I would request Mr. Sudhin Roy Chaudhary, retired member Life IITI, member ICC National Expert Committee on BFSI, to deliver a special address. And request yourself to make go live, make a video on sir. Mr. Sudhin Roy Chaudhary, sir. Hello.
Yeah, Mr. Surendra Chaudhary.
Can you hear me?
Yes, sir. But your video is not, sir.
I'm not seeing on the video.
You, sir, please kindly start your videos and we can see you also, sir.
Okay. First of all, a very good afternoon to all of you. And I'm very happy that Indian Chamber of Commerce is having these webinars on various subjects. And this present subject of today, understanding the impact of pandemic on retirement benefit planning, is very important at this crucial stage. I mean, it's like the pandemic to happen to ensure that people understand what is the importance of long-term planning and savings and retirement and health insurance. So friends, retirement is a culmination of decades of hard work put in one's career. This should be the golden period of life and one should be free from financial worries. Retirement planning is about ensuring financial independence for an individual after he concludes his active work life. The concept of this pension and annuity is a British concept brought in by the Britishers for the simple reason that a person works for 30, 35 or 40 years and after that he goes in for retirement. And then he would like to have a good pension scheme so that his retirement days he can be well taken care of. Unfortunately, in India, people start realizing about the importance of retirement only at the fag end of their career. Because you see, in government services, pension is already there, so people don't worry about it. But in the private sector and other, even non-private sector also, in the unorganized sector, nobody talks of pension or retirement benefits. Anyway, however, retirement planning remains one of the low-rated priorities among the working population because most people feel that retirement is far away and nearer term priorities seem important. For many, there are financial obligations like home loan, EMIs, children's education, saving for children's marriage, etc., and accumulating a large sum for carefree retirement seems a daunting task for them. While the task is daunting, it is quite achievable if one has a good financial plan in place and starts saving for retirement early in one's career. The pension industry in India is highly underpenetrated. as nearly 88% of the labor force is without any formal pension provision, which indicates that the market has huge growth potential. In the recent years, the investment avenues available for retirement planning have enlarged to quite a large extent, because we see that mostly all the life insurance companies have their separate pension and annuity plans. Of course, LIC is the leader in these areas. The introduction of the national pension system in 2004 was a great moment for the Indian pension industry, whereby there was a radical shift from a government-enabled pension program to employee-oriented pension program, where employees started contributing towards their own retirement funds while employed. Here I would like to mention that in the pension funds which was run by the government, the ROI, return on investment of the individuals, was far less, whereas in the NPS scheme, it was left open and the return on investment was much higher than in the government pension schemes. So in a sense, it is better for young employees to invest in the NPS scheme rather than have a cushioned government scheme. And moreover, government has now withdrawn their scheme and is encouraging NPS more and more. The Employees Provident Fund, EPF, Public Provident Fund, PPF, retirement and superannuation plans offered by insurance companies and mutual funds are also some of the important avenues where people invest for their retirement years. Not to mention the equity market also, because if you invest in equities and keep them for a long time, they may come in handy at the time of your retirement or post-retirement years. Perhaps the one positive outcome of the uncertainty following the COVID pandemic could be that it has driven home the significance of financial planning and security, compelling many to rethink their priorities. Because this sort of situation was never seen in decades and decades earlier, where the whole world was put under total lockdown practically. And still it is like that going on. The terror of this pandemic has not gone, and God knows how far it will continue. So, as I said, the positive outcome of the uncertainty following the COVID pandemic could be that it has driven up the significance of financial planning and security, compelling many to rethink their priorities. People are beginning to understand the importance of long-term financial planning. They are beginning to understand that retirement planning is very, very important at these crucial hours. This is evidenced by the importance given to both retirement and inheritance planning. A simple example, on 21st of October this month, LIC is withdrawing their Jeevan Shanti plan, which is literally a pension plan, annuity plan. And I'm sure that they will mop up a few thousand crores from the market, because people would like to have such plans for their future. Market fluctuations and job uncertainties are making people focus on long-term goals for self and family. Emergency savings have become the biggest reason for saving for people. While increasing the standard of living is still important to people, but now they are saving more in long-term savings and retirement, and securing inheritance have gained higher importance. Here also I would like to add one point, that whereas whole life policies was important in the UK and they used to be sold as inheritance products, in India it did not pick up. In fact, the period from maybe 60s to 90s, there was hardly any whole life policy being sold. However, people have realized, and now also they have realized the importance of a whole life plan, whereby you can create a inheritance for your beloved ones after you pass away from this world. So, like many other aspects of our lives, this pandemic has altered the way Indians save and invest. But as with any major crisis, it has brought home the realities of people's financial lives, compelling them to focus on securing their financial futures with emergency funds in place and money allocated to long-term investments. Along with this, I would suggest that the insurance company should also think of having a pension fund or an annuity fund policy linked with a health insurance plan also, which is very important for people in senior age. Once they retire, health is a very big issue, and these two products can take care of people after they retire from their active service. So thank you very much and wish this conference a good success. And I'm again happy that Indian Chamber of Commerce is arranging such webinars where you have very esteemed people like Mr. Supratim Bandyopadhyay is there, Suranjan, Mr. Banerjee, Mr. Basros Kamdin and others. So wish you all the best. I rest my speech over here. Thank you.
Thank you, sir. Now we would request Chairman Sir, Mr. Supratim Bandyopadhyay to deliver the keynote address.
Everybody. Thank you, Mr. Taneja. Thank you, Mr. Roy Chaudhary. It's very nice to hear Mr. Roy Chaudhary after a long time. Many of you may not know that we spent almost 3.5 decades together in same insurance industry. Senior to me, we learned insurance from him. And thank you my co-speakers, Suranjan Banerjee, very senior actuary from Willis Tower Watson. His area of specialization is retirement benefits. And Madam Basros Kamdin from Deloitte, senior partner, who will be talking on the tax implications. So I want to specifically thank ICC during this pandemic also to arrange this kind of webinars so that we can create some kind of awareness about pension. I take off from where Mr. Roy Chaudhary has left, that he has very rightly pointed out pension is not our priority today. And younger generation, they are deferring the issue of pension to a great extent, so much so that maybe post 50, they are thinking of setting aside a small corpus, and which ultimately is not enough to meet their requirements, because it is not only retirement, but post-retirement, the period for which people are alive today because of the better mortality experiences is sometimes beyond 20 years also. And that is the Indian experience. So that's why this kind of awareness sessions are very important. And I'm thankful that you are arranging it. And we had sessions with ICC earlier also. To give you a small brief about NPS, actually there'll be a small change in the program today. Mr. A.G. Das is held up in another ministry related program. So along with my keynote address, I want to show you a small presentation. I'll start the presentation, but with a small comment that I'm very happy to share with you. Today is a great day for us because total assets under NPS, APY, all controlled by PFRDA has crossed 5 trillion rupees just a couple of days earlier. We are now at 5.05 lakh crore. It's a small milestone, I know, in our long journey, but a milestone nonetheless. So I thought I should share it with you. So to start with the presentation, if you look at the features of NPS, what actually makes it very unique is that, change the slide, please. It's a portable kind of a product. Normally, when you have some kind of a investment account, you change your job. Sometimes it is related to your job. Sometimes it is related to the kind of activity that you are carrying out. So it needs to be changed. It's need to be stopped, or you have to start afresh somewhere else. It is not like that. It is a portable kind of account which you can take anywhere you like. You change a job from government sector to private sector. You go into your own practices and all that. You can carry that same account number, which we called PRAN, permanent retirement account number. So that is unique and that can be taken anywhere and you can contribute. Very, very low cost. I'll just give you a small example here that how low cost it is that if somebody contributes 1,000 rupees a month for 35 to 40 years, the overall cost comes to only 0.02%. So much so, our fund managers charge a fund management fee of only 1 basis point. For every 100 rupees they manage for you, they charge only 1 paise. I believe this kind of a low cost structure will not get anywhere in the world. Lot of flexible choices we have. Choices in the sense that you can choose your fund manager. We have 7 fund managers. You can choose from them. You can have your own investment allocation. If you wish to do the investment allocation on your own, you do it. If you find that the investment allocation is a little difficult for you, you can leave it to life cycle funds, so that with your age going up, the risky asset allocation, that is equity, goes down, corporate bond goes down, and government security, which is taken to be the safest asset class, there the allocation goes up on its own on the birthday, every birthday. Automatically, it is a system driven change that you don't have to do anything. You can have your own contribution level depending on the cash flow available with you. You go for a SIP with a mutual fund, or you take an insurance product, your contribution is fixed. At any point of time, like we are going through pandemics now, suppose the cash flow is low, somebody wants that last year I invested 50,000 or a lakh in NPS. Do I have to invest that much? No. You can invest as low as 1,000 rupees also, and or 500 rupees also. So you can continue with your account without any hassle. So lots of flexibilities are there. And other flexibilities, some of the flexibilities I really want to talk about is that at the age of 60, when somebody is really going out superannuating, you need not take the annuity at that point of time. If you want, you can defer the annuity part by 3 years. If you wish to continue to contribute in that account, you can continue up to the age of 70. If you want the 60% withdrawal, which is given at any point of time at the point of retirement, tax-free, not to take it at one go, lump sum, you can distribute it over 10 years in equal installments. So I believe if you look at the flexibilities also, very few products will be available in the market which will give all these kind of flexibilities, taking into account different situations a human being will go through. It has got attractive returns. About returns, I'll talk to you later. It's very, very tax efficient. It has exclusive tax benefits. I leave it to Madam Beros because she will be talking about taxation aspects. But only one thing I want to say, that it has an exclusive 50,000 rupees per year tax benefit if you invest in it, NPS, under Section 80 CCD 1B, which is not there for any other financial product. Very, very transparent. Every day at the end of the day, we declare the result, we declare the net asset value per unit. So you can know where your investment has gone up, where it is exactly, how many units you have. You have online access to your account at any point of time during the day. So you can know where your account is heading. If you wish to change your asset allocation immediately, you can change it. During the year, you can change asset allocation twice a year without any cost. You can change even your fund manager. If you are not happy with the performance of your fund manager, you can change the fund manager also once a year, free of cost. And obviously, it is a regulated kind of business. So absolutely no hassle on that front, that it is well regulated. We have well laid down investment guidelines, data maintenance, data preservation, safety, security, everything is built in. We have two kinds of accounts. Tier 1 is a compulsory account. So anybody coming into NPS has to open a Tier 1 account, where that is known as the main pension account, where tax benefits are available. There are restrictions on withdrawal. Though technically EPFO, PPF, all these products we take as a replacement of pension, but if you look at it, we take pension as something which ensures, the system itself ensures that there is a regular income at the point of superannuation. But EPFO, again, withdrawals are there. So many cases we find that 80-90% of the total corpus is withdrawn before the person is retired. So hardly anything is left which can support that person during the old age. Here we allow partial withdrawals, but we ensure that a large part of the corpus remain within the system, and at least at the point of retirement, 40% of the corpus is annuitized, which will ensure a regular income, which is not there in many other schemes. Minimum contribution is 500 rupees, and per year you have to contribute at least 1000 rupees, and there is no limit on contribution. People think that 50,000 is the limit on contribution, but that is only the tax benefit part. If somebody wants, they can invest any amount that they like. Tier 2 is an optional account. If you have Tier 1, you can open a Tier 2. The benefits are it is easily withdrawable. Unlike Tier 1, you can withdraw from Tier 2 anytime you like, any amount you like. If you want to wish to redeem all the units you have in the Tier 2, you can do it without any compulsion from our side. However, there will be no tax benefit, obviously, because all these other benefits come with this cost, that no tax exemptions will be available. Here, as I said, there is unrestricted withdrawal. And we also suggest people who are opening Tier 1 that you have something under Tier 2 also, because whenever you need money in between, you can use Tier 2 and withdraw the money. And there also, there is no limit on contribution. You can contribute anytime you like. Now, if you look at the entry process, when you join, what age you can join? Between 18 to 65. Actually, earlier we had our age of entry limited to 60 only. We used to get a lot of requests from people that those who have just retired, maybe they were not aware, they want to create a pension fund, pension corpus. So we allowed entry up to the age of 65. But if somebody is joining at the age of 60, he or she has to remain within the system for at least 3 more years. And thereafter, at any point, they can withdraw and go. Obviously, there has to be KYC. The KYC norms, as we all know, is applicable to other financial products. Here also it is there. And there are two modes. One is physical, obviously, but now we are encouraging more and more online modes, and many online modes we have enabled during this pandemic period. And as a result, we have seen a decent growth in number, almost 13-14% growth in the number of subscribers who have onboarded during this period vis-a-vis last year, as well as there is a growth of almost 21-22% in the corpus. Inflows also have increased in a very, very decent fashion. After entry, the next phase starts, that is the accumulation phase. So it can be, if we are basically here, we are looking at the corporate sector. So if it is a corporate sector, it can be by the corporate, the employer and the employee. It can be by the employer alone. It can be by the employee alone. Or there can be unequal contribution between the employer and employee. Any kind of permutation and combination will do. There is no such fixed kind of a contribution level that we are insisting on. So obviously, when the money comes, it is according to the choice of the subscriber or the corporate, it is given to the investment manager. Suppose somebody chooses uh, fund A, it will go to fund A only. And they invest the money according to our investment guidelines. And at the end of the day, as I said, every day they are supposed to declare their NAV the same way mutual funds also manage their day-to-day affairs. The same way we are also managing. Our fund management system is mark to market. So yes, we admit that it is open to market risks, but I'll show you the returns and long-term returns that too. That will give you the confidence to see that how well these funds are managed during this period. So once the NAV is declared, at the end of the day, units are allocated. So when you are looking at your accounts, what you will see that how many units you have accumulated in your account and what is the value per unit. So multiplication of the two will generate the value of the corpus, and at the point of retirement, this entire corpus is utilized. 60% anybody can withdraw tax-free as a commutation, which again is far better than insurance and other sectors where though they are allowing 60%, but entire thing is not tax-free. But here entire 60% is tax-free and balance 40% has to be necessarily annuitized. There are two kinds of exits that can happen. One is a normal exit at the age of 60 or maybe at the age of superannuation as decided by the corporate. In case of a premature exit, 80% has to be annuitized. Only 20% can be taken back as lump sum. So that is a small stricture that we have put. Again, that is to discourage premature exit. But if the corpus, total corpus, which is left is less than 1 lakh, in that case, we don't follow that 20-80% formula. We allow entire amount to be withdrawn. Under normal circumstances, as I said, 60% is given back and 40% is annuitized. But if somebody wants to take 100% annuity also, they are definitely welcome. They can convert the entire corpus into annuity. Here also, if the corpus at the point of retirement is 2 lakh or less, then entire amount can be given back if the person wants that. After the exit, the annuity obviously is provided by the annuity service providers. These are all insurance regulator IRDA controlled entities. We have kindly 12 and they have a bouquet of products, kind of annuities that they have, and all the types of annuities with their relative rate of returns. These are displayed on our website. At the point of retirement, people can look at it, people can choose from it, and then they decide where to go and which particular annuity to choose from. Here only one word about the annuity is that annuity being a fixed guaranteed kind of a return that is promised lifelong. Obviously, tracking the interest rate scenario in the market, annuity rates have come down and come down drastically. So much so that if somebody at the age of 60 wants an annuity with a return of corpus on the date of the annuitant, the rate of annuity is anything between 5.5% to 6%. So we have been talking to IRDA, we have been talking to annuity service providers to look into other modes of giving annuity or maybe variable annuity kind of thing, if they can look into, because increasingly we are getting complaints, not really complaints, letters from annuitants or would-be annuitants that they feel that when at the accumulation phase they have got a very, very decent return, why at the annuitization stage they will be stuck to 5.5% to 6%, and that too for lifelong, without a possibility of that rising. Record keepers are separate. what we have done, pension fund managers don't keep the records of their subscribers. Everything is separated. So as a pension fund manager, I can know how much money I am managing, but I will not know whose money is there. So for that, currently we have two record keepers. One is NSDL e-governance and one is KFintech. They are managing all the database, customer database for the entire NPS system. Currently, we have 7 fund managers: SBI, LIC, UTI, ICICI, HDFC, Kotak, and Aditya Birla. These are sponsored by these groups, but according to our rules and regulations, all these fund managers are separate entities. They are board driven entities and they have a separate legal standing. So these are sponsored by their parent companies, either life insurance companies or maybe they are other entities like mutual funds. They have promoted these companies. As I said, if somebody at the point of asset allocation is quite convinced that he knows where to invest, we have 4 choices out of which he can choose. If he is choosing equity, we allow maximum 75% in equity, then balance 25% he has to take from corporate bond, government security, or alternate asset. If they choose government security or corporate bonds, they have the option to go 100% in these asset classes without choosing other asset classes. But it can be always a mix and match of all these 4 asset classes. And the last asset class, the alternate asset, it includes new assets, new instruments like real estate investment trust, infrastructure investment trust, alternate investment fund, AIFs, tier 1 bonds, additional tier 1 bonds of banks, all these things. These being little risky in nature, we have limited that allocation to only 5%. So if they wish, they can put 5% and our fund managers will choose the right kind of asset for him and put it there. And if somebody is not very confident as to where to put and does not know his risk appetite, then they can go for a auto choice. Auto choice are nothing but, as I said, life cycle fund. LC stands for life cycle. 75, 50, and 25. 75 means we call it an aggressive life cycle fund, where up to 35 years of age, equity allocation will remain 75%. And corporate bond will 10%, and thereafter GSEC will be 15%. But as I said, after 35 years, as the age goes up, 36, 37, with each anniversary, birthday, the allocation in equity and corporate bond will come down, whereas that in GSEC will go up. Similar thing happens with LC50 and LC25. LC50, we call it moderate auto choice fund, where only 50% initially is put in equity and then it is brought down. And LC25 is a very, very conservative kind of a life cycle fund, where the initial equity allocation is 25%, then it comes down. So these are the 3 choices basically we have given according to your risk appetite. If you feel, yes, I am ready to start, I am young, I am ready to start with 75%, I can take a little bit more risk. You can go to 75% and thereafter it will be automatically brought down. Because normally what happens, once we invest, we tend to forget where we have invested and how much we have allocated to each fund. So here you really need not remind yourself every year, yes, I have to do something, because the system will take care of that asset allocation thereafter. I was talking about returns. If you look at the returns, and pension fund being long-term funds, one has to look into long-term returns. Equity, despite this volatility in 11 years, because our equity fund started way back in 2009. So the CAGR is 9.71%. Corporate bonds, despite all these credit events that which has put corporate bond market in turmoil, Despite that, in 11 years has given a 10.31% return, and government security in 11 years has given 10.13% return. So if you take a one third, one third, one third kind of asset mix also, so blended return, if you look at, it will be little over maybe or very close to 10%, which I believe for a long-term fund, 11 years standing is not bad, looking into account that all the risk-based parameters that we have put in place to ensure that the funds remain safe. We allow equity only in large cap stocks with 5,000 crore or more market capitalization, those who are in futures and option segment, those which are well researched, we get a lot of reports on them. Similarly, corporate bonds also normally AA plus and above, they are investing in with 2 ratings listed. We don't allow any unlisted private companies where people can go and invest. So all these things are there. And with listing, a lot of disclosures are also coming in. Obviously, government security, there is no such requirement, but they are also, they very capably, they are managing the duration in such a way, they are getting more than 10% return. We have 2 blended funds like central government scheme. As Mr. Roy Choudhury pointed out, it started from 2004 with central government employees, and that is there for 12 years now. It has only a 15% equity exposure, and in 12 years, it has given a compounded return of 9.93%. State government scheme started mainly from 2009, and that also has given 9.83, and they are also, the investment pattern is same, only 15% is allowed in equity. So funds where traditionally it will be taken as very conservative kind of investment, they are also this kind of returns we are able to generate over a period of time. Look at our subscriber base. Yes, a large number of subscribers are coming. Almost 2/3 of our subscribers are coming from APY. APY is a product which is, the returns are guaranteed by Government of India. At the point of investment, they are guaranteeing 8%. And when it is annuitized, irrespective of the annuity market conditions, as we discussed, now lifetime annuity with return of corpus is somewhere between 5.5% to 6%. There also government has assured a return of at least 7%. Currently, so far as our returns are concerned on APY funds, 3 fund managers are managing it: LIC, SBI, and UTI. If you take average return of all these 3 fund managers, 5 years this product is there. It was launched in 2015. We are giving something around 9.5%, though the guaranteed return was 8. So there we are scoring much above the guarantee. But where we are falling short is that annuity rates have gone down drastically. So that is a big challenge. But obviously, when government guarantee is there, that will be taken care of. Central government has little over 21 lakh contributors here, subscribers. State government 49 lakh. So that is about 70 lakh taken together. The corporate sector that we are talking about today is little over 10.5 lakh. And I believe we have huge scope in the corporate sector, because though there are 8,000 corporates, more than 8,100 corporates who have registered with us, the number of employees who are actually joining is very less, because 8,100 corporates result into 10.5 lakh kind of total subscribers. So it's not even 125 per corporate. And there are big corporates where they have ensured all their employees join. Like recently, Indian Oil has joined. That is also coming under corporate sector. And there, Indian Oil alone, more than 23,000 employees have joined. So if you take it out, in some of the corporates, it will be maybe not even in double digit. So there is a lot of scope in corporate sectors, and I believe the employers also, they have to handhold their employees. They have to tell them about what Mr. Raichudri was telling. It's a very important message that he has given, is that maybe the pandemic has taught many of us that we have to save something for the rainy day, for the future. And we also see that as people are working from home, maybe they have little more time to think, and they are also thinking that there are job cards, there are salary cards. So these are realities which we never thought maybe 1 year earlier that this kind of situation will come. So these are also realities. So they have to really build up a corpus for the future. So maybe that's why people are thinking in terms of a pension in a bigger way. And the unorganized sector, UOS, basically that is a real retail sector, where also it is a voluntary segment. They are 13.5 lakh, 13,75,000 people have joined. And there also we are seeing a lot of traction. NPS Lite is a scheme that was there earlier in 2015. It was withdrawn when NPS was launched. That was also a government guaranteed scheme that has about 43 lakh subscribers, those who are still continuing with us. And as I said at the initial part of my address, that we have crossed 5 lakh crore. Today we are standing at 5 lakh 5,000. And a large part of that, almost more than 80%, comes from central government and state government employees. So far as corporate sector is concerned, it contributes about 52,000 crore of total corpus, which is just above 10-11% of the total corpus that is contributed by corporates. But here also we feel that there is a lot of things that we can do. Then certain web portals. We have NPS app on iOS and Google Play Store. Everywhere it is available. So if you download in your mobile, you can see on the go that what is your total fund size like, how it has grown. If you want to contribute through the mobile app, you can contribute. And one more important thing that I'll let you know, a few days back, from the beginning of this month, October, we have allowed one de-remittance, de-remit we call it. Through that process, if you contribute to your bank account through your net banking system, by 8:30 in the morning, you will get the NAV of the same day. Earlier, actually, the process was little time taking. Normally, if you contribute on a Monday, you will get it on Wednesday. We call it T+2, the day of transaction plus 2 days. But now we have cut down on those 2 days so that people, those who are really watching the market and want to get into the market on a particular day at a particular value, they can do it through DRemit that we have recently started. And we have these few days, we have seen almost more than 7,500 people getting registered through DRemit. That means people, our customers are watching and they are lapping up this facility. We have a strong grievance redressal system through the concerned intermediary. If it is not done, it will come to the NPS trust. Thereafter, it goes to the ombudsman. We have a ombudsman in place. And then also, if the concerned applicant does not like the order of the ombudsman, can escalate it to the authority PFRDA. And ultimately, if PFRDA order is also not liked by the complainant, they can go to the Securities Appellate Tribunal, and that is the last stage. So that is the end of my presentation. I once again want to thank ICC for giving us this opportunity. Would like to hear from Mr. Suranjan Banerjee and Madam Perose. And thereafter, I believe after the session is over, whatever questions are there, we'll be too happy to answer those things. Thank you.
Thank you, sir. Mr. Suranjan Banerjee, would welcome you to address us.
Yes, thank you. Am I audible?
Yes, sir.
Okay, great. Can I request Milind to share the slides, or if I have control, maybe I can put them up myself.
Yes, sir. You can share your screen, sir.
Okay, great. Sorry. In which case, just bear with me. Okay, great. So are my slides visible? If somebody can just confirm, I can make a start.
Yes, sir.
Yeah.
Obviously.
Okay. Okay, excellent. Yeah, thank you. Thank you, Mr. Chairman, and to the ICC, and good afternoon, everyone who's on the webcast today. Firstly, sir, many congratulations to you and to the PFRDA for crossing the 5 trillion rupee mark as assets under management, and that too in such a short period of time. As always, it's a great pleasure and privilege to be speaking at one of these events and to share the virtual panel nowadays with such distinguished individuals. Okay, right. So in terms of my session, which I will take over the next few minutes, I will focus on giving you some insights from two different sort of surveys that we've run recently in the last 12 months or so. And whilst the surveys themselves don't specifically focus on COVID-19, I think it's worth remembering that quite a few of the interim relief measures have either been already taken up or exhausted, and also individuals do need to consider and think beyond the pandemic, in order to create the right level of savings for a sustainable retirement, and if anything with more rigor, as mentioned by Mr. Roy Chaudhary in his opening address. A quick introduction to the surveys themselves. I think the first survey is actually pertaining to how the individuals in the organized sector are feeling about the retirement benefit savings. And when I say organized sector, this is not the government sector, or organized sector excluding the government sector employees. And the survey was itself carried out in 2019, where we interviewed several thousand individuals across several countries on a wide variety of topics related to their current financial situation. And as you can imagine, with surveys such as big as this, publishing them takes a bit of time, though the results I can assure you are still relevant. And this included a substantial section on retirement benefits. And as you can imagine, retirement savings are an integral part of anybody's overall financial plan. And the highlights relating to those I will share with you in the subsequent slides. The second survey, which is actually quite hot off the press, and we've kind of sort of barely managed to compile our findings, but I did manage to get some sneak previews on some of those results, are basically, the other side of the coin, right, which is from employers, where, we had about 160 plus private sector companies across various, industries like pharma, FMCG, manufacturing, IT, telecom, participate. And we kind of heard from their side as to how they're looking at the benefits they're providing to their employees in the space of retirement. And we believe that these two surveys, when considered together, will present to you two sides of essentially the same coin, where we can see how employees perceive their retirement benefits and how the employer, who in most cases is either the sponsor or the facilitator of these benefits, viewing the same provisions. Right. Okay. So with that, let me dive in. So I think before I get into the Indian context or look at the Indian side of the findings, I think there are some global themes which are probably worth mentioning. And I won't spend too much time on the global themes, but because a lot of these respondents are from countries which are sort of a little bit ahead of us in the sense of their sort of their loss of demographic dividend, or which are a little more mature populations. If you look at average ages, it's good to pick up on these things because these are potential either issues which we're facing today or are likely to become issues in the future. Right. So first of all, there's been a definite erosion of the retirement provision seen very clearly, right? And the easiest and the most simple example is, a switch from, let's say, a final salary type defined benefit plan to a simple defined contribution plan. And when I say simple, it's fairly simple in how it operates, but behind the scenes, there's always a bit of a risk transfer, right? And then with that weakening of the provision or a transfer of risk, and the large scale prevalence of the defined contribution plans, the individuals now need to understand the risks that have inherently been transferred over to them, right? Risks which would typically previously be borne either by the employer or the government are now being borne by individuals. And whilst regulators are doing their bit, for example, by having, let's say, default investment strategies, which help employees reduce risk over time, I think, as Mr. Chairman highlighted, the life cycle fund is a great such example. We feel employers probably need to do a little bit more in their role in terms of education of employees and spreading the awareness of this inherent risk within some of their retirement plans. And finally, we also found in the survey that individuals who are now approaching their retirement ages are A, servicing larger levels of debt, and B, with smaller proportion of housing wealth, right? So now this is important because to be able to dedicate or devote more of your financial resources towards long-term savings or retirement plans, you also are going to have competition with immediate debt servicing. And what we find is that people are either taking on more debt or have more other pressing financial commitments, which are typically keeping them away from actually, allocating enough resources towards their long-term savings pot, which of course includes the retirement piece. Okay, so now let me go on to some of the findings which are more specific to India. And you'll see four statistics here, and some of them are a little bit make us a little bit nervous. Right. So I think the first one is that 30% of respondents from India actually felt that they're not heading in the right direction in relation to their overall financial position. Now, this would typically include various aspects such as access to emergency funds, long-term savings, key life goals, retirement savings, debt management, and all the rest of it. So this is just one number which kind of stood out for us, saying that look, 30% people are actually not happy with their overall financial condition. Uh, Another 30% also felt that they're not heading in the right direction, specifically in relation to their retirement savings. So these could be the same people or other, a slightly different cohort, but they are the ones who are saying, look, we don't think we're doing enough for our retirement savings. They might have their own reasons. So remember, these are employees, so they may have their own reasons for saying some certain things, but the numbers look pretty significant. If you move to the bottom side of the screen, you'll find that 60% actually feel they're not saving enough for retirement, to be able to, who don't have adequate savings to be able to retire typically at ages which, previous generations would have typically retired at, whether that be 60 or 65, but they just don't feel they have created sufficient resource or sufficient funds to be able to stop active employment. And finally, just a little bit of good news. The bottom right-hand side of the screen is, more than half of these individuals have also increased their allocation to retirement savings in the last 2 years. Now, it's a different issue as to what they consider to be adequate, or what we consider might be adequate, and what they've actually managed to do. But at least, a lot of people who have the knowledge that they're probably not doing enough are at least trying to see, how they can move things around and dedicate a little more resource towards their retirement planning. Just extending this point a little bit further, I think we find that, if we were to take, now those are different questions with sort of overlapping answers, but, essentially if we put all of those survey respondents back together and actually made three different non-concurrent cohorts, then we can broadly find that roughly 30% feel that they're falling behind. What that basically means is that they know that they are not doing enough, and they're basically not able to do enough either, right? They just find themselves in a spot where, unfortunately, whilst they feel they should be doing more, they're not able to do more. Another 30% are the ones who are saying that, we do know that we need to do more. And in the past 2 years, we have taken certain measures or certain steps, in the right direction. For example, join voluntary NPS programs, or increase their contribution towards a VPF. But basically, they are saying that, look, we are doing what we feel is necessary, though we're not quite there yet. And then the balance 40% feel they're on the right track, meaning that they already have earmarked certain funds, or they have enough assets that they built up, or they don't have any debt, and they feel that they've got a robust retirement plan. So roughly 30% think they're not there, 30% think they're getting there, and a 40% feel that they are pretty well set up. Right. Okay. So, I mean, given my basic qualification is that of an actuary, I thought, I must have at least one slide with some numbers and calculations. So what I've done here is basically, an attempt to try and quantify what might be an appropriate rate of saving, for an individual. And what I'll do is I'll rely on a very basic and simple concept of the net replacement ratio in order to explain these calculations. Now, very simply put, this particular figure of the net replacement ratio defines how much you're likely to have as regular income just after retirement, expressed as a percentage expressed as a percentage of what you were receiving just before you retire. Just for example, if somebody had a final salary of 1 lakh rupees and then ended up receiving a pension of 50,000, then essentially their replacement ratio is 50%, which means they're able to replace their salary with half of that as pension. Now, going by some examples we have from other countries, typically a replacement ratio of about 50 to 70% can be considered a reasonable starting point. And this is when you include any social security programs that you typically see in the West, which unfortunately, I mean, don't really exist in India, at least not for the private sector. This should ideally be adjusted for taxes, but just to keep my calculation simple and just to highlight the main points, I've ignored taxes in my example at the moment. So let's consider somebody who starts working at the age of 23 with a basic salary of 25,000 a month. The other key assumptions are actually in the bottom of the screen. I'll let you read them, but a slightly more conservative approach towards investment returns, because I think we are heading towards a slightly lower interest rate regime and a long-term rate of inflation of about 5% per annum. So what did we find? So we found that, if the individual had only got access to the statutory benefits, and let's say he joined, in a regime where PF was absolutely mandatory, then the PF accumulation and the gratuity, as per the PG Act put together, and if all of that lump sum at retirement was used to convert into a flat annuity, then the income would basically achieve a rate of replacement of 34%, which means just using the statutory benefits, an individual would be able to generate a pension which is about 1/3 of what they were earning just before they retired. Adding access to superannuation funds, I know these are not as popular or not as prevalent now, but in India we've got a fairly limited basket of retirement benefits. But if you add a superannuation fund on top of the basic statutory benefits, you'll typically be able to increase your replacement ratio to about 46%, or just under the 50% mark, which I gave you in my example. And then finally, adding NPS, and the good thing about NPS is, you can go 10% of basic, but uncapped, and with robust investment returns, you can actually pull that 46% up to a 63, which then starts getting into a territory where we can, be a little more comfortable that, at least we're getting to that 60% plus kind of threshold, because as you know, in retirement, whilst you may not be commuting to work, but you will need a lot more, let's say, medical support, right? So your spends are not going to go down by that much. So on the one hand, these figures, are a little bit heartening, saying that, look, if people are doing this, then, they should be able to achieve certain reasonable outcomes. But I must, present some caveats also with these numbers that I put on screen. Now, this particular example, the individual starts contributing from the age of 23. Now, unfortunately, we know that that doesn't necessarily always happen. And like Mr. Chairman mentioned, people tend to defer decisions, particularly with respect to their retirement savings, to an age sometimes which becomes so late that it's just not possible to create a significant amount of wealth. For example, if somebody starts in their late 40s or early 50s, it'll be very, very difficult to create any kind of corpus which would give them a reasonable pension income. A second point I want to point out is that in my example here, I've taken basic salary as 50% of gross, which basically means that all the contributions here are pegged to, roughly what is 50% of your total salary. However, in reality, what we find in the market is, companies have not actually pegged their basic to 50%, but are at lower levels, the median being about 35, 40%, which basically means that, if an individual was actually out there with a basic salary of 35%, they'll have to actually save a lot more, to be able to get the same kind of replacement ratio, because what you earn is gross, but your contributions are all based on basic salary, which is effectively a much smaller number. And finally, the point I made earlier about the investment risk. So the above outcomes are in no shape or form guaranteed. So remember, nobody's taking a guarantee of providing a certain replacement ratio, as you did have in the erstwhile defined benefit plans that, government sector employees might be retiring on 50% salary, but the risk being with the government. In this case, the risk is with the individual, and any investment returns higher than expected annuity rates, and of course inflation in the period after retirement, because these are flat pensions. As inflation will erode their wealth post retirement, where do they get that extra bit of money from, right? So these things need to be kept in mind as well. But just to give you a flavor of how a retirement benefit plan could play out, and the importance of actually starting early, I hope I've been able to draw some inferences into that for you. Okay, let me now move on to the other survey, and let's just flip this around and look at it from the point of view of employers, and take a look at what they've been thinking about the retirement benefit offerings at their companies. Just a little bit about the survey. So this was conducted just a couple of months ago, around July, August time, where we were in the middle of the pandemic. So basically, we can assume that a lot of the responses that we've got on this survey in particular from the companies was keeping in mind that the pandemic was actually, at least at that stage, impacting their business. Oops, sorry. Okay, the first slide I've got is on the prevalence of the national pension system, or the corporate model of the national pension system, where companies have been adopting and offering it to employees primarily on a voluntary basis, or on a salary sacrifice arrangement, as we call it. And we find that the number of companies providing NPS has actually gone up from 43% when we did this survey last year to 51% in 2020, which is obviously a good outcome, because companies are now thinking more and more about NPS. And I think Mr. Chairman mentioned a figure of about 8,000 corporates. We see that number steadily growing in the future as well, because we do find that another 20% are in the process of either implementing NPS already, or are considering its implementation within the next 12 months. Now, having personally assisted a lot of our clients during the lockdown period, and despite lockdown and despite people not being in offices, I think the PFRDA, the central record keeping agencies, and the POPs actually deserve quite a special mention, because all steps were taken to ensure that enrollments could take place virtually, whether it be sort of new accounts, migrations, intersector shifting. All of that actually has, in our view, helped enrollments despite us going through such a tough pandemic. And further, I think just from our own experience, we found that given a lot of individuals were actually working from home, we generally saw, a rather, a larger than usual interest levels in the awareness sessions that we ran, because, again, going back to the point that Mr. Roy Chaudhary also made, people are now thinking about these things a little bit more, and hopefully that will translate to better take-up rates when we run these surveys in the future. But one clear issue remains that when NPS is offered on a voluntary basis, and I think Mr. Chairman also mentioned this, the take-up rates still seem to be a bit of an issue in terms of them being fairly low, right? So if you look at the results on the top half of the screen, you'll find that the take up or the take up of the voluntary corporate NPS program still remains about 11%. Which roughly means that basically, a little more than 1 out of 10 people who are eligible for the program actually take it up. And our, survey pool is actually much smaller than Mr. Chairman, than presented earlier. I think, the actual overall average, if you look at across the 8,000 employers, would actually be typically lower than this because they may not have, been part of our survey. One potential, thing that could have come in the way, and we felt, talking to individuals, was potentially the new tax regime. So, I think it'll be good if we can create, again, the employer also has an obligation to do so, is to make sure that their employees are aware of, certain implications of what the new tax regime brings. And I think, Ms. Behrouz Kamdin will talk about these probably in much more detail. But I think the key is to make sure that individuals are aware of what the implications are, rather than just fear of the unknown, saying, "Oh, I don't know what's happening. It's best to sort of stay away." Um, Additionally, if you look at some of the other responses on the bottom half of the screen, we found that almost half of the employers actually let employees choose any percentage they want to contribute to NPS, which is great, because we are a big fan of starting early, even if it's starting small, right? So if I'm a 23-year-old in my example, maybe I don't want to start at 10% on NPS, but at least I started 5% or 3%. Just the idea of putting something away for my retirement, is good. And then slowly over time, as my salary goes up, or as my basic costs get covered, I can start allocating more towards my NPS program. And finally, if you look at the green bars, you'll find that, and this is something that we've seen, which is quite interesting, is employers are now more open to help individuals enroll in NPS. Now, in this particular case, we find that about 1/4 of our respondents actually who've actually rolled out NPS, did so by supporting their employees with some fairly basic charges, at the point of enrollment. But then again, that's it. It just creates that value proposition for employees, saying, okay, fine, I don't have to worry about the charges at enrollment. So maybe that encourages me to at least come and listen to what the NPS has to offer. Okay, this slide probably more specific for companies who've got superannuation plans, and shows that there's been an interest from companies to enable portability from legacy superannuation funds over to the NPS. Now, this has been available for some time, but we feel that this is actually quite a slow mover, and because only 8% of companies who have already enabled it. The good news, another 34% are thinking about it, but there's still a significant proportion of superannuation funds out there who are not currently actively considering enabling portability to NPS. Now, could be several reasons for that. Firstly, an approved superannuation fund, any changes you make have to be approved by the Commissioner of Income Tax, or the local Commissioner of Income Tax. And, generally we find that it takes quite a bit of time to get that done. And secondly, wherever you've got your money, typically with, let's say, an insurance company, it's becoming, early experience has shown it's not that easy to get the funds out. So companies, they're thinking that, okay, let me leave the superannuation plan, but let me at least also offer NPS in addition. And over time, maybe slowly we can gradually enable the portability as well. Okay, my last sort of couple of slides, I'm going to little bit focus on the recent regulatory updates. And of course, the two recent ones, one very high level. Again, I'm not a tax expert, so I'll leave that for Ms. Kamdin, but just, just because it happened this year and we have some responses, we had 1 or 2 questions in our survey. I thought it was worth just pointing out, and if you look at the question, it basically talked about whether you made any changes to your retirement benefit contribution patterns in light of the fact that now there is an overall ceiling of 7.5 lakh for total employer contributions in any fiscal year towards an individual. What we found, which was interesting, is that an overwhelming 84% of respondents said that they'd actually not taken any steps. So, which basically means, again, they're just leaving everything on their employees, and they assume that the employees will understand this and make certain decisions which will hopefully be the best ones for them. But again, goes back to the point that we feel that employers probably could do a bit more especially in times where employees may not be so sure as to what's going on. Another 7% said, they are looking at changing the overall compensation structure, and finally 5% said, look, maybe we didn't have the flexibility within NPS, so we're going to let people, given PF remains statutory, let us see if we can, move things around, give people more flexibility on the NPS side to make their compensation structure a bit more tax efficient. Okay, so my last slide, and again, I think wasn't possible to stay away from the recent announcement in terms of the code on wages, which came out last year, or the code on social security, which is sort of just come out and is knocking our doors as we speak. Now, I'm by no means an expert in this area, but I think again, it was definitely worth a mention. So a lot of companies, I think the first and foremost is the broadening of the definition of wages. And what we find is that a lot of companies will now need to review the overall compensation structure and reconsider how they determine, what are qualifying wages, reckonable wages, whatever you might want to call them, but whatever wage they are using for determining certain key benefits, such as, let's say, gratuity payments or PF contributions. Now, prima facie, one way of doing this could be to just uplift the basic salary. Like we said, if the market median is 35%, 40%, you just take it up to 50. Maybe that gets rid of all the other problems, but then we need to understand what could be the potential knock-on effects of this on certain other things, right? So for example, the moment you touch basic salary, typical Payment of Gratuity Act says, okay, that's the salary we're now going to use for gratuity payments, which in turn increases not only your future payouts when people leave, because it's now pegged to a higher salary, but in your books of accounts, you're certainly going to have your liability provisions increase, and of course, the ongoing expense to service new accruals for your employees over time. And finally, the statutory PF contributions are also going to increase. And given India has the CTC concept, if the employer does not put in additional money, it's going to actually take a hit on the take-home pay for employees, because they, from their overall CTC, they're now going to be contributing a larger chunk towards their PF contributions, because the qualifying salary would have actually been considered to be higher. And finally, if you look at the bottom of the screen, I think despite the large consequences, it is still surprising that only 13% of the companies we actually spoke to have actually assessed the impact of this definition change on their long-term retirement benefit liabilities, right? So again, I think most companies have adopted what could be considered a wait and watch approach, but now, given some recent announcements that all these codes could come in together maybe sort of early to April next year, I think maybe this is going to be the time when companies have to reassess and look at these things in more detail, as they also in parallel come out of the impact that the pandemic would have had on their underlying business. Okay, so I think that's all I have. So I will stop here, and I thank everyone for your time, and I look forward to the questions in the Q&A session. Thank you.
Thank you, sir. So the chairman, sir, you would like to address, sir?
I believe I don't have anything more or new to add. Now we can have the last presentation, and then we can have the question and answers, or if anybody has any questions that we can answer.
No, questions are there. What we'll do at the end, sir. Then let's invite Suranjan Banerjee, sir. Huh? Oh, Madam Barrow's coming. Sorry.
Good afternoon to all, and thank you, Mr. Padia, Chairman PFRDA. Thank you, Indian Chamber of Commerce, and Mr. Roy Chaudhary. Thank you. Hello, Mr. Banerjee, and thanks to all participants for joining in. This session is at a very appropriate time today. So if you've known, today is the World Students' Day, and we are discussing retirement benefits on the World Students' Day. Mr. Banerjee did mention that there's a lot of benefits if you start early in life. And I think that needs to get communicated to all, to say you need to start early in life for retirement benefits. And what best time to start our World Students' Day. So what we're going to be discussing today is basically to see what are the incentives that are there for investing in retirement benefits. and how NPS has an advantage over other retirement benefit schemes. So from an NPS perspective, before we go to tax, I think there are two things which are very important, and Mr. Bandapadia did mention about it, to say that, and I've actually experienced it myself. So when I was in my first job, I left the job after 8 years of service, and there were contributions made to a superannuation fund at that point of time. But since I had not completed 10 years, I was not eligible for pension. So I lost my contribution which was made. And this is something which NPS is very important, because even if you leave job or you change jobs, your contribution, the employer's contribution is there in the NPS account, which can continue. So you're not going to lose your money. You may get pension at the age of 60, but your money stays with you, which is a very important factor. Globally, it's already there, and India has brought this about. I think this is a very important factor to be noticed, to say that your pension amount contribution is not lost. The second important factor of NPS is that you don't need to be an employee. Even as an individual, I can contribute and the money stays in the pension account, and I can withdraw at the time of retirement or at the age of 60. So that is something very important, because once we are partners, we are not employees, we're not contributing to any provident fund. So we don't have EPF, we don't have superannuation funds. So in that context, people who are not employees, it's very important that you have this sort of a pension scheme. And therefore, I think NPS has an advantage over there. And everyone needs to realize that it's not only employees, but even their family members who are into not working or into practice or their own business. NPS is a very important retirement planning tool. So it's something which most people should have as an investment opportunity for retirement. When we look at return on investments, so generally what we do is we evaluate various sort of options that are available, whether it's provident fund, whether it's EPFO, or whether it's public provident fund, or whether it is shares, units, mutual funds, debt securities. Whenever we evaluate something, we look at it to say, what is the return on the investment that I'm going to get? And then we look at the tax impact of it. So whenever we look at the return on investment, we look at return on investment net of tax, because that's the money which is going to come to me. My cash flow depends on the tax that I'm going to pay on that and what are tax advantages which are there. So if you go to the next slide, Milind. Thank you. Next one. So in a retirement planning situation, what we look at is 4 aspects: the entire life cycle which is there of the contributions. So one, when the contributions are made by the employer, does the employer get a deduction for the same? Because it should not be a case where the employer does not get tax benefit or some amount gets disallowed. Second, what is looked at is the employer's contribution going to be taxed in the hands of the employee? So is he going to be paying tax on that amount as his salary? The third is, what is the employee's contribution? Is that going to be allowed as a deduction? So one is, I'm making investment on which I'm going to earn some income, but do I also get a tax benefit by making that investment? So that is that second aspect which we look at. The third is the annual accretion on that money which is lying in the pension account or any retirement account. What happens with my annual accretion? Is it going to be taxed? Is it exempt? Because again, my return on investments will depend upon that. And the withdrawal. How much amount when I withdraw is going to be taxed? How much is not going to be taxed? And what is the implications? So the entire life cycle of a retirement account is looked at in this manner. Next slide. Milind, can we go to the next slide?
Next slide is on, man.
After this, next to this. So slide which is speaking on 80CCD. So what we've done is we've discussed basically what are tax benefits available for investing in NPS. I'm actually not able to see the next slide, Milind. I'm not sure. Can you hear me?
Yeah, we hear you.
Okay. So I can discuss on it till the time that Milind puts up the slides. Basically to say that when a contribution is made by the employer to a provident fund, that amount is allowed as a deduction for the employer. Similarly, when a contribution is made by an employer to an NPS account, even that is allowed as a deduction because it's an expenditure incurred by an employer for employee salary, and therefore it is allowed as a deduction. Now, on the contribution made by the employer to the employee, if it's less than 10% of the salary, then the entire employer's contribution to an NPS account is fully taxable under section 17(1). It is taken as salary of the employee. But what they have done is, so the entire contribution which is done by the employer is taken as salary of the employee. However, you get a deduction under 80 CCD 1. No, sorry, the earlier slide. Yeah. So when we talk of employer's contribution, entire amount contributed by the employer to NPS account is salary. And what they have done further, and which is the amendment which Mr. Banerjee referred to and Mr. Bantapadi also referred to, and we will discuss in the later slides, is that this amount of contribution is also now included in the overall limit of 7,50,000. So we will discuss this overall limit of 7,50,000. But presently, to know that employer's contribution is fully taxable. But the employee gets a deduction under 80 CCD to the extent of 10% of basic salary. So if the employer is contributing 10% of basic salary, then the entire amount is allowed as a deduction. So therefore, there is no tax impact. In case of central government employees, the deduction is to the extent of 14% because central governments presently contribute 14% of salary as employer's contribution, and the entire 14% is allowed as a deduction. What we understand is that state governments also contribute 14% of the salary as employer's contribution, but the amendment which has been done in tax law is only restricted to central government. So therefore, the state government contribution in excess of 10% of salary may be taxable because that is not being deductible under 80 CCD. And I understand the government is evaluating and looking at the same. Now, in the current year, what we've seen is that government now does not want to give benefits for tax purposes. So what government's view has been is that you should do your investments and savings and investments not from perspective of earning tax benefit, but basically because you need to do the investments and savings. And therefore, they have come out with an alternative or optional schemes which are there. One is an individual can get taxed at the normal rate of tax which is applicable, which is slab rates of taxes. Or alternatively, an individual can go under a lower rate of tax, which has been provided. That is also on slab basis, but there are lower rates of tax, but you do not get any deductions. So an individual can go under lower rate of tax, but still the employer contribution will still get a deduction. So there will be no tax on the employer contribution. We come to the employee's contribution. Now, employees' contribution, like we said, in case of self-employed taxpayers or professionals or individuals who are not employees, you get a deduction up to 20% of the gross income of whatever is being contributed to NPS. In case of employees, the deduction is restricted to 10% of the salary plus dearance allowance. So an employee, if you contribute to NPS, 10% of your salary plus dearance allowance, the entire contribution will be allowed as a deduction under 80 CCD 1. Subject to it being covered under the threshold limit of 1,50,000. So we are all aware that under 80C, we get a deduction for PF, PPF, insurance policies, premiums, etc., etc. So we have a limit of 1,50,000. So this 1,50,000 limit also covers employees or individuals' contribution made to NPS. But like Mr. Bandyopadhyay mentioned, there's an exclusive benefit given to a contribution to NPS. Immediately as soon as you contribute, even if you've crossed the threshold of 1,50,000, you get an additional 50,000 benefit for employees or individuals' contribution to the NPS account. So if you look at, if you're on the highest slab rate, say a 34% slab rate, you immediately get tax benefit. So you've contributed 50,000 rupees, which is a tax benefit exclusively for NPS. And if you're in the highest tax bracket, you get a benefit for that. However, if you were to go under lower rate of tax, which is a new scheme which has been introduced, and you get a lower rate of tax, then you do not get any employee's contribution. So this is something which government should look at, because there have been questions raised on it. Should their tax be an advantage or a benefit should be given to individuals, or should they do investments otherwise? See, I think otherwise you do investments, and people say compare it with mutual funds and say in mutual funds you don't get benefits for contributing. Then why should we get benefits on NPS? There are two different reasons for it. One, when I contribute to NPS, I cannot withdraw till the age of 60. Most of my money is bound in that account for till I attain the age of 60 years or 65 or 70. So there's a mandatory requirement of lock-in. Second thing is retirement is something different from just investment. Here I'm saving for my retirement. I don't have any social security benefits given by government of India. So if the government is not giving me social security benefits, then somewhere when I'm making investments for my retirement benefits, there should be some tax advantage to it. And therefore, I think somewhere people have to look at it differently to say mutual fund investments is very different as compared to an investment in NPS account. And therefore, investments for retirement should have certain tax breaks. And government should relook at it, even if I go on a lower rate of tax. Presently, it's not there. Presently, if you go on a lower rate of tax, you don't get any benefits. But government should relook at this thing again. Now we come to the annual accretion. Annual accretion to NPS accounts till last year was not taxable. You could not withdraw the annual accretions and it remained in the account, but it was not taxable. In the Finance Act 2020, there's been an amendment made. The amendment says that any employer's contribution to Provident Fund, to NPS, to Superannuation Fund, if it exceeds 7,50,000, then the excess of that should be taxable. So they are talking of only employer's contribution. So any employer's contribution to any of these three accounts, if the total amount exceeds 7,50,000, then the excess should be taxable as a perquisite. What happens to the annual accretion? So the annual accretion on this excess will be taxed. That means that the annual accretion on the employee's contribution, annual accretion to the employer's contribution, if it doesn't exceed 7,50,000, should not be taxed. Now, how this annual accretion is going to be worked out, rules have to come out from income tax, whether the priority has to be set as to what comes in the first 7,50,000 and what is the excess. Is it attributed to PF? Is it attributed to NPS? Or is it attributed to superannuation? Those rules are still to come out, and the government is working on the same, and we expect the rules to come out before the end of this year. And post that, only the annual accretion, what is taxable, is the amount of accretion on the excess over 7,50,000. So up to 7,50,000, there's nothing which is taxable. And also, employees' contribution annual accretion is not taxable. So that is something which is of advantage, and it continues. Withdrawal from the fund during the previous year. So if the fund is being closed, the NPS account is being closed on retirement, or you're opting out of the scheme, the section says that the entire amount is taxable. But they have given us benefits, they have given exemptions. They say that to the extent that you take an annuity policy, that amount, which is 40% in normal circumstances, then that 40% is not taxable. So to the extent you take an annuity policy, it's not taxable. And then under exemption section, section 10 is a general exemption section for income tax. They have said that 60% is not taxable of the amount that is payable. That means on the whole, 100% is not taxable. And therefore, it's very nearly now an EEE scheme to say exempt, exempt, exempt. When you're putting in a contribution, it's not taxable, and you also get a benefit if you're in the normal rate of tax. The annual accretions which are there is not taxable if you don't exceed the 7,50,000 rupees. And then what is taxable is only about the accretion on the employer's contribution alone, which exceeds 7,50,000. And when you withdraw, the entire 100% is not taxable, because 40% you buy an annuity policy, which is not taxable, and 60% is an exemption given under section 1012A. So in that sense, an NPS account is now an EEE account, exempt, exempt, exempt account. The annuities that you received, once the policy is taken, those annuities are taxable. So whatever you receive post maturity of the NPS account, that entire amount of that annuity is taxable. Now there also there's a lot of questions and debates being done. We have different schemes of annuities. So it is sometimes you get the entire cost, what you've purchased the annuity is returned back on the death of the annuitant, or you could have annuity policy where you don't get the cost returned, but you get an incremental annuity which is coming to you till the life of that person. Or sometimes there are several separate 7 annuity schemes which are there of insurance companies. All need to be looked at, but where it is, so where we are not getting the cost back and I have purchased the annuity policy, there should be some deduction that should be allowed, because actually it's the cost of the policy and I'm not getting my money back on maturity or on death, in which case the entire annuity being taxed seems to be unreasonable. So maybe some discussions should be happening on this, and government should look at it to say how the cost of the annuity policy should be allowed as a deduction, and only the net, some sort of a working. And globally, what we understand is in certain countries, they have given this deduction. It's spread across certain years. It's not given in the first year itself. It's spread across 5 to 10 years. But at least the cost of the policy is taken as a deduction. However, the cost of the policy is going to be returned back to the annuitant on his death, then the same should not be, then you cannot get a deduction again. So on withdrawal from the fund, like we said, it's exempt from tax, but the annuity that you receive post the taking of the policy is fully taxable. Partial withdrawal from the fund during the financial year. In this pandemic, we've seen that there have been partial withdrawals allowed by NPS, and income tax also says 25% of the total amount payable to an employee is exempt. So whatever at the time of partial withdrawal. So whatever employee contribution is there and some amount has been withdrawn, which is less than 25% of the employee contribution, then that amount may not be taxable under section 1012B. But the words used here is employee. They don't use the word individual or assessee or taxpayer. So the question comes is, if it's an individual who's opened an NPS account and he does a partial withdrawal, or a non-employee who's opening an NPS account and he does a partial withdrawal, what happens in that case? And the entire amount gets taxed. Today, as it stands, it appears that the entire amount is taxable on partial withdrawal by a person other than an employee. If you look at contribution tier 2 account by central government employees, so you can have a tier 1 account and a tier 2 account. Tier 2 account is very similar to a mutual fund account, where you can make contribution as much as you want, you can withdraw as you want. So there's no restrictions maintained. It's not that you need to keep that account for 20, 30 years and you can withdraw anytime. So there is no tax benefit for it. For any contributions that you make, there's no tax benefit. Whatever accrual happens on tier 2 account, it should not be taxed till such time that is withdrawn, because like normal units of a mutual fund, if there's distribution which is made, it will be taxable. If there's no distribution, then whatever you withdraw should be capital gains or loss, and it should be taxed accordingly. They have now provided that if an employee of central government, and this is only for central government employees, contribute to the specified account and hold it for 3-year period in tier 2, then they are allowed a deduction under section 80C. So this is also within the overall limit of 1,50,000, but they still come as a deduction. So this benefit has been given only in case of employees of central government. It is presently not applicable to state governments. It's not applicable to employees in private sector. It's not applicable to individuals. This benefit has been given only to central government employees. So government can look at it. But again, this benefit is only for those employees who are not opting for the lower rate of tax. Because once you go under lower rate of tax, which is there under section 115 BAC, you can't get any deductions. So no deductions allowed if you go under lower rate of tax. If you're under normal rate of tax, you can claim this as a deduction. The next slide, Milan, please. This is the next slide that we spoke about to say on the Finance Act amendment, which has happened. So earlier we had the concept of employer's contribution to NPS, which was under section 17(1) to say entire employer's contribution is taxable as salary. Employer's contribution to provident fund. So there's a schedule 4 of the Income Tax Act, which says that any employer's contribution more than 12% of the basic NDA would be taxable as per schedule 4 of the Income Tax Act. You also had an employer's contribution to approved superannuation fund, which said that if it exceeds 1,50,000 rupees, then that excess is taxable. So anything which exceeds 1,50,000 rupees was taxable. So we had 3 separate contributions. by the employer to provident fund to superannuation fund to national pension scheme, and different tax implications were there. In the Finance Act, what they have done is now they have said that the employer's contribution to recognized provident fund, NPS, and approved superannuation fund, which exceeds 7,50,000 rupees, will be taxable. This is what we were mentioning, that the entire amount over and above 7,50,000 will be taxable. So now we can see, and maybe it may happen that having a separate superannuation fund is not required. See, earlier we used to have a separate NPS account, we used to have separate superannuation fund, we used to have separate provident funds, and there was a separate tax benefit for it. So if I had a contribution superannuation fund up to 1,50,000 was not taxable earlier. But now the entire contribution has been clubbed together, aggregated in these three contributions. And so there could be many cases where there could be a porting from superannuation fund to NPS. Because having a separate superannuation fund and having administrative cost attached to it now is not required, because everything can come under an NPS account. And there's no tax benefit of having a superannuation fund. So I think now going forward, I think we will see many superannuation funds re-looking at porting their fund to NPS, of course, considering the approvals that are required from commissioners, and also consider cost involved, because they would have had investments made somewhere, and if you have to liquidate those investments, there's cost involved to it. So considering commercially, but from a tax perspective, there's no need to have a separate superannuation fund. And the second amendment which they did was the annual accretion. So the wordings are annual accretion by way of interest, dividend, or any other amount of similar nature during the previous year to the balance or credit of the fund or the scheme, to the extent it relates to contribution referred to said subclause, which is included total income. So whatever is in excess of 7,50,000, what is included in my total income, the annual accretion on that will also be taxable. Now, annual accretion, when the way they have worded it, says interest, dividend, or any other sum amount of similar nature. Similar should be something similar to interest or dividend. Now, when you look at an NPS account, NPS does not have any interest or dividend being declared. It's not like a mutual fund where you have income declared on your units of a mutual fund. We just have units which have been allocated, like Mr. Bandyopadhyay mentioned. We have an NAV, net asset value of that fund, being determined on a daily basis. And that gives you the accretion or reduction. So there could be cases where my NAV has gone down as compared to my contribution, or there could be cases where an NAV is higher than the contribution. Now, whether that increase in the NAV should be taken to be akin to interest, dividend, or other sum, we'll have to wait and see what the rules say. Once the rules are out, this will be more clear. But if that is the view taken, then there could be some amount of accretion that could be taxed in case of an employer's contribution, only if it exceeds 7,50,000. And after we determine as to the priority as to how it is going to be determined, whether it's going to go to recognized provident fund, or whether you can say it's to superannuation fund, entire excess of superannuation, or whether it's partially to all of the three. So we will have to wait and see what the rules say. And the rules should come out because this changes happen in the current year. The accretion would come in the current year itself. So I think before the last quarter of this year, we should have rules being issued by CBDT on it. The next slide. This is just on COVID reliefs to say government has given a huge economic package to individuals and people of India. And I think PF also has done that. They have said that employer can reduce their contribution of 12 to 10% for a particular period which was there. Then they could have a non-refundable advance. And this is something which was being discussed to say whether it could have tax implications. Because in PF withdrawals also, there are restrictions which are there under Income Tax Act. If you withdraw before 5 years of completion, it could be taxed. So you need to look at those conditions which are there and whether there's any doubt that this amount could be taxable. However, since it's only a non-refundable advance and the account is not closed, a view can also be taken that this advance should not be taxable. But at least you need to document it to say whatever view you take, whether it's taxable or not, at least a proper evaluation has to be done. Like we mentioned, PFRDA also has allowed partial withdrawal for treatment of medical expenses. And we discussed that if there's a partial withdrawal, employees may get a benefit for tax. But if it's non-employees, that whole partial withdrawal may be taxable. So that needs to be looked into. And if it's taxable, you need to pay a tax on it. Because of the lockdown and pandemic, the timeline for making investments were extended. So for the financial year 1920, generally you have to make investments by 31st of March 2020. Because of the lockdown which came about in the last week of March and people could not make investments, the government have extended timeline till 31st July 2020. So all your investments you could make by 31st July and claim a deduction in the earlier year. So you're making a deduction post the year, but you're claiming a benefit for tax in the earlier year. So you're going to get a refund faster if you make those deductions. So this was very good benefit which government has given. And this included also NPS. So whatever investments you made in NPS by 31st July, you can actually claim a deduction if it's not already covering the limits in the earlier period itself in 1920. Then extension of timeline filing the return of income for financial 1920, which was earlier to be in July, has been extended till 30th November 2020. So you still have time to file your returns and you can make those claims for investments that you make. That's it from us today, I think. Yeah. So we are happy to take questions and thank you so much.
Thank you, ma'am. We have few questions for Chairman sir.
Yes, please.
Is not making the retirement benefit subject to market risk make our social security unsafe?
I didn't get the question. Can you repeat it once again?
Is not making the retirement benefit subject to market risk make our social security unsafe? I mean, basically, I think he's implying equity component increasing makes our social security unsafe.
Yeah. I got it. So maybe who raised the question wanted to know whether it has to be a kind of a guaranteed kind of a return or something like that. But what we have seen now, market linked investments worldwide, even for retirement benefit sector, is in the vogue, because nobody today wants to give a guarantee in a uncertain kind of a market. If you look at it, even in insurance also, there were guaranteed products, maybe even 10 years back. But slowly IRDA has ensured that all the guaranteed products are withdrawn from the market. So there are two ways of giving a return if you don't give a guarantee. Is that whatever you earn, you pass it on after deducting a charge, or secondly, you make it mark to market. So that whatever you earn, interest plus maybe part of your equity profit, which is being followed by EPFO. There also, if you see over the years, EPFO returns are also not constant. It has come down and come down drastically. In fact, we have compared last 10 years from 2008 to 2018-19. We compared the EPFO returns along with our returns because our schemes are in place since 2008. And there also we have seen our overall returns are far, far better than EPFO. So there is no such thing as a guaranteed return. And today, if you talk about guarantee, people are talking of only giving a capital guarantee. If you are putting 100 rupees with me and I am investing 100 rupees net of charges, say I am putting 95 rupees. After 15 years, 20 years, I'll be ensuring only that 95 rupees. So that is not the kind of guarantee what people will be looking for, because the markets are very volatile, very uncertain. In this market, nobody can afford to give a guarantee. And if they give a guarantee, the charges will be so high, ultimately it will cut into the rate of guarantee. So either way, it will not work. So we believe, and those who conceived NPS, they also believed, and rightly so, because whatever they believed, now it is proved, because now we have 11 to 12 years of track record and the returns we have shown. So that proves that in a longer term also, we could sustain the market volatility and we could ride that market volatility and we could give a very, very decent return under the circumstances with taking the least bit of risk in equity.
So next question, sir, if I invest in NPS now, can I do it for FY 18-19? or is that deadline over? Since IT return date has been extended till I think 30th November. Can I do it for 1819 or will it be counted for, or rather 1920, or should I do it for 2021?
As
If I
I
include now.
understand, as Madam Kamroj also has specifically mentioned
Hmm.
that it was extended only up to 31st July, the investment timeline period.
Hmm.
So, and it was not for 1819, it was only allowed for the
For
year
1920.
1920.
Yeah.
Because 1920, the last part of 1920, as you all know, that was affected by pandemic and all that, and people could not invest during the timeline of 31st March. So for them, this benefit was extended by another 4 months. So you cannot take a benefit for the financial year 1819. You can obviously take 1920 had you invested within 31st July.
Okay. Next question is, you had mentioned in that there will be some changes in cost structures for the fund managers with a floor and a cap. Will the cost structure increase? And next question is,
Yes.
it, uh,
Next
the
question.
next question is along with the attached question. Someone who has fixed a deduction of 50,000, the cost gets deducted from the corpus, not over and above the corpus. So this is an actual fact, sir. For 50,000, the net contribution becomes 49,600, something like that. So, but the question is, why is not the cost structure deducted over and above the 50,000? Why does the net contribution get reduced? And if the cost structure gets further increases, then the net contribution will be again less. Why don't we then make the deduction of
It will be
51,000?
little less. It will be little less. And secondly, as you said, yes, cost structure definitely, if we are going to review, we are going to review it upwards. Obviously, there is no question of reviewing it downwards, because as I said, our fund managers charge only 1 basis point. The lowest cost structure in mutual fund, because our system of fund management is exactly equal to mutual funds. So if you look at mutual funds, what kind of total expense ratios that they are charging, that you can look at, is multiple times higher than us. Maybe sometimes 50 times, 60 times, 100 times
Yes,
higher
but
than
it is
us.
multiple times higher. Yes.
So that is there, and they are charging 1 paise, and obviously they are making losses. So if somebody is there in fund management business, we also have to ensure over a period of time they make some kind of a reasonable kind of a profit, so that they can run their business, they can upgrade their infrastructure, they can get the right kind of manpower, because this requires, fund management requires a lot of research support. And these people, fund managers, research analysts, they come at a huge cost. And IT infrastructure also, the kind of IT infrastructures that they require, and continuous upgradation that they require, that also will require huge kind of outlay. So we have to ensure that they have that kind of money. And at the same time, if we start introducing some kind of products, like we are thinking of giving a minimum assured return scheme, we are talking to the pension fund managers. The moment a guarantee will come into play, they will require higher capital. So from the cost structure also, if they can keep aside a part of their money to shore up their capital as and when they require, so that is there. So definitely it will go up. But we will also ensure that it is within a very, very reasonable range. So maybe the subscribers will not feel the pinch, and the difference will be maybe second or third decimal point in the NAV. So nobody will even see the difference.
So what is your advice to increase the net contribution every year to cover up the cost structure so that the 50,000 doesn't get affected? So no one wants whatever 50,000, 25,000, whatever. No one wants a cost to be deducted from the corpus.
So that what can be done, we have a definite cost structure. Whatever is deducted from this thing, if that is added at the point of contribution, so
Yeah.
that will remain. The net will remain 50,000.
Yes.
Otherwise, also mutual fund also, it is the same thing, that it is deducted and net amount only is invested.
Okay, sir. Next is you have mentioned about flexible annuities, systemic withdrawals, and does it mean that mandatory lock-in is for pension scheme is reducing or something going
No,
or
no, no.
something?
No, it has nothing to do with the mandatory lock-in. Mandatory lock-in will remain. This systematic withdrawal or whatever you are talking about, flexible annuity, it is at the exit point. When a person is retiring and going out, now the only option, as I said in my presentation, is getting an annuity. And annuity rates are coming down. It's pretty low now, 5.5 to 6%. So people are not happy with that. So we are thinking of talking to IRDA. We have already talked to IRDA also, whether they can allow the annuity service providers to have variable rates of annuity, which can to some extent give protection from the inflation. You have seen the recent rate of inflation also 7.34%.
Right.
So if you are giving 5.5% return net of inflation, actually it is a negative return that
Yes.
they are getting if you look at it. So
That is
that is
the
a kind of
RBI.
thing, but that will be post retirement. That is nothing to do with the mandatory lock-in period.
And that is the reason RBI is putting on hold the interest reviews in monetary policy reviews. Now, so another question is, we give, what answer I don't know. We give guaranteed tax to the government. Why we should face so much risk at the fag end of life? I mean, what is he expecting?
Yeah,
I mean,
that I believe Madam Beros has already addressed that why taxing the annuity, because since there is no social security scheme, so to say, to support the taxpayers. So why at the end of the life, when I am utilizing the corpus to get an annuity, get a pension, why put a tax on that? And she has very rightly said that there are different kind of annuities. In one annuity, the annuitant gets annuity till he or she is alive, and post the death of the annuitant, the entire corpus comes back. The tax treatment there can be different, but where on death of the annuitant, the corpus does not come back, there we definitely need a differential kind of a tax treatment, where definitely the tax rates can be lowered or it can be removed. So that has been our constant endeavor with the governments in the budget proposals that we send. So this time also definitely it will be there. So ultimately it is for the government to consider. They have a lot of constraints otherwise also. There are demands from different sectors, different organizations. So they have to balance, mix and match all those things. So, but definitely from our side, that prayer always will be there.
the last question is, sir, can you explain a bit about the video KYC? I mean, is it only offered by you? I mean, and how simple it is, different from the paperwork and all that?
No, video KYC was initially offered by RBI. And on the same lines, then SEBI brought it. I think that was sometime in April this year. So after seeing that and the kind of challenges that we are seeing during pandemic, that people cannot visit and have their KYC in person. So we thought, why not implement the same thing? So what we said, many of our distribution channels are controlled by RBI, like they are banks, and many of them are controlled by SEBI, like broking firms and all that. So we say that if you are controlled by RBI, the same process which RBI has given and you are doing for your banking customers, you do the same process for NPS, it will be accepted. And similarly for SEBI controlled entities, we told them whatever SEBI has given, you follow. And that's how we have enabled it, so that people need not visit. And it will be a very easy process, because banks are already doing it. They are in the process for at least last 6-7 months. So they have that experience, and we don't think that it will be a problem. So we got our board approval recently, and we have asked our distribution channels to utilize it. Yes, please.
Another question has just, oh, no, madam is no, no, sir, no more questions, sir. As of
No, so
May
I
I
just
ask something?
answered the question that they had put in. I've not raised a question. I've just answered. There was a question raised that whether contribution of PF and superannuation fund of 7,50,000 will be treated as a perquisite, not the contribution, only excess over and above 7,50,000 will be taken as a
Exactly.
perquisite.
Exactly.
Only the excess amount, not the total contribution. If it's less than 7,50,000, then it is not taxable.
Exactly. So, any other questions, Mr. Ghosh?
No, no, sir. As of now, if anything had gone to any speaker personally, I don't know, but to me,
Can I just refer to one question which was raised earlier, and I think by Deepan Mitra. So if you look at it, even globally, so pension funds and large pension funds globally, whether it's US, UK, or Canada, or Australia, where you have a huge pension fund industry, they do investments in equity and in debt securities. So there is some market risk which is attached to it, but it doesn't mean that if you invest in PF, Provident Fund, even our EPFO invest in the market. So there is a market risk attached to all retirement funds, and it's not very peculiar to NPS. Maybe, of course, the way Mr. Bandyopadhyay mentioned that if they can work through and give us some guaranteed or assured returns, that will be the best part of it. But even otherwise, I think all of the retirement benefits do have market risk attached to it.
Thank you, ma'am. Thank you, sir. Then with this, we would like to thank all the speakers and the delegates and close the session today.
Thank you. Thank you so much.
Great.
Thank
Thank
you.
you, everyone. Take care. Bye-bye.
Thank you. Bye.